predictive models for taxpayer behavior. These are just some of the tools being explored. But how far can we go? And how do we ensure these technologies are used responsibly without undermining trust or fairness? To explore these questions, we are very fortunate today to be joined by three outstanding speakers. We have Gabriel Turek, Assistant Professor of Economics at the University of Pittsburgh. He will be followed by Victor Poliquin, Senior Lecturer in Economics at the University of Essex. And lastly, Joseph Eloy, Economic Policy Specialist at the World Bank. I also want to say that Gabriel and Victor are affiliated to the Abdul Latif Jamil Poverty Action Lab, JPAL, who funded the work they are presenting today. JPAL is a global research center working to reduce poverty by ensuring that policy is informed by scientific evidence. And I want to particularly thank Abdoulaye Ndiaye, Project Director at JPAL Africa, where he leads the Digitalization and Finance Initiative, DigiFI Africa. JPAL provided most of the intellectual content to this webinar, and we are grateful for that. It also, highlights how this whole series is meant to build connections across research centers and beyond. Awesome. In terms of logistics, there is a Q&A chat, as you can see, for all participants to intervene. Feel free, don't be shy, feel free to leave your questions there. Those will be addressed either via text by all of us or orally after the presentations. And this session is also recorded. All the material that you will see today will be shared afterwards. Awesome. Without further ado, I will just then leave the floor to Gabriel, who will present insights from DRC. Hello, Gabriel. Hi. The floor is yours.
Can you see my slides?
Yes, perfectly.
Great. I'm very excited to discuss this work in this setting. It's work that we did a couple years ago in a very limited setting, but I think it demonstrates how these techniques like machine learning and computer vision, which are components of artificial intelligence, can be deployed in a local taxation setting with potentially high returns. So the title of this short piece of the webinar is Enhancing Property Tax Rolls Using Machine Learning and Computer Vision. This work was conducted in Kananga in the Democratic Republic of the Congo. So the context here is property taxation. But I wanted to back up a little bit and begin with, I think, observation that many of us are aware of, or a fact that we know that limited tax capacity often constrains government's ability to invest in the things they need to do, funding public goods like basic infrastructure, health, and education. The problem is that low-income countries in particular often find themselves in almost a trap that they find it difficult to collect enough tax revenue to make those investments. But those investments themselves might drive people's investment in the economy or in even their willingness to pay the tax. And so we observe that low-income countries are collecting less than 10% of their GDP in taxes. When compared to higher income countries, that's an order of magnitude of about 5 times less. However, that level resembles the level of what high-income countries were collecting about 100 years ago. So one perspective is that these low-income countries are at a stage of development where there might be high returns to investing in tax capacity. I think a lot of the evidence that we have about solutions for building tax capacity is that there's many tools available and they have different returns. But it's not an easy technical fix or a one-size-fits-all solution. Rather, governments and at the national and local levels need to make investments in economic growth alongside investments in building capacity and stronger state institutions. Essentially, that it's a larger project that leads to strengthening tax capacity. I think the project that I'll talk about today falls into the category of more of a small technical fix, but I think it demonstrates the potential for these solutions to provide stepping stones towards building that capacity in the short run. Okay. And I'll be talking about property tax collection, which is usually collected at the local tax level in many settings. When we think about property taxes, the purview of local governments, like city governments or in some case county level governments, this tax is very different from those we encounter at the national level, like personal income taxes, corporate income taxes, consumption-based taxes like value added. because of who's in charge of collecting it, but also the revenues that countries typically gain from this revenue base. And property tax surprisingly stands out as an underutilized and underexploited source of taxes when we compare the revenues from different tax bases across low-income and high-income countries. Personal income taxes look very different, so do corporate income and value-added taxes, but not that different when we compare the share of revenues coming from each of those bases in lower-income countries compared to the shares in higher-income countries. When you look at property taxes, however, the property tax itself and revenues from it emerge as a highly underexploited tax, that richer countries are collecting much larger shares of total revenue from property taxes compared to lower income countries. And I think this is a reason why there's been a lot of attention paid towards property taxation, both because of its underutilized nature, but also because it provides a primary source of revenue for local governments. That at the local level, these governments that are often tasked with providing public goods and services directly to their constituents in a very hyper-local sense, they depend heavily on these sources of revenue, and increasing property tax can be a source for increasing funds available for those investments. Property taxes are also thought to be more equitable in the sense that they are levied at low rates on broad bases. Everyone has to pay them. They're usually less than 3% of the value of the property. And they're usually progressive, meaning that more valuable properties face a higher tax burden. And this is thought to be potentially more socially equitable than some regressive tax bases that we observe, like value-added tax is essentially a regressive tax that puts a higher burden on lower income consumers. And I think thinking through a more political economy lens, building a relationship between taxation at the local level and citizens might support a stronger contract by which citizens give money to the government, expecting that that's spent on local public goods and services, and that might bind more tightly at the local level. The key challenge in property taxes is you need some form of information to build the tax base. You need to value properties in some way to impose a tax on them. And mapping and valuing properties can be extremely expensive. And this, I think for this reason, we observe that the mapping and valuation itself is extremely underdeveloped in developing countries. For example, only around 15% of sub-Saharan African cities have mapped the urban plots in those cities. And I think less than 35% of non-OECD countries have mapped the areas that we would think would be a base for property taxes. Okay, so how do governments, when they do choose to map areas to support estimating property value, forming this base for property taxes to impose taxes on that base, how do they do it? There's two traditional approaches throughout the world, and these apply not only in low-income countries, but also middle and high-income countries. And the first and most common one, which we apply in the United States where I live, is manual appraisal. This means someone comes and visits your property, takes note of all the features. They come inside the building, look at the outside of the building, and categorize different features, how many floors it has, how many windows, the quality of the materials used, the state of deterioration. And this is very time consuming, as you might imagine, and very labor intensive. However, it's thought to be very accurate. These are experienced land surveyors in some cases, or estimators of building value, and they can come up through experience and comparing to other properties with a number that is a reflection of the true value of the property. There's reasons to think, however, that this method might also be vulnerable to corruption and elite capture, that the people who are hired to do that work might choose to assign property values in areas that might advantage those they are close to and disadvantage people that they are more disconnected from. And so there's concerns that this, even though it's accurate, it can be expensive and then vulnerable to these risks. An alternative method that I think is closest to the method I'll be talking about that we deployed in this study is points-based valuation. And this is using limited property and area characteristics. You could imagine using surface area estimates from satellite imagery, just capturing how big the roof is, how big the plot size is, and then collecting some information about the surrounding area of the property, and then assigning weights to that information. So you say a property that is this large has this many points assigned to it. One that has multiple floors has this many points assigned to it. And then you build an aggregation of points and assign property taxes on the basis of those points. So it's sort of adding up all the information you can observe from available sources. And the problem is that this might not be as accurate as the manual appraisal, and the information can become quickly outdated. So imagine that you do this once, and then you assign points and taxes, but then properties change over time, they're built, they're remodeled, or they're destroyed, and then that information is not, if not updated, will be incomplete or inaccurate. What our intervention in this setting in Kananga aimed to do was to build on these approaches to build a property tax roll using available methods from machine learning and computer vision algorithms in a particular urban setting, which is the city of Kananga in the DRC. And to give you some brief background, Kananga is the capital of the Kasai Central province. It's the fourth largest city in the DRC, has about 2 million residents today. This is a very high poverty setting, so average household income on a monthly basis is only around 106 US dollars. And the government collects a very limited local tax revenue, the provincial government, which is collecting only about 30 cents per person annually. The property tax forms about a quarter of these revenues, but there's a lot of room to grow, essentially. And the system that they impose is very simple. They classify buildings according to the materials that was used to build them, that were used to build them, non-durable materials like mud bricks, or durable materials like concrete. And then depending on which materials you use to build the house, you're assigned a particular tax rate. To enforce the tax, there's relatively limited technical and administrative capacity. The government, the provincial government sent agents around in 2018 to do a door-to-door survey to collect information about the property. And in 2019, they undertook a mapping of infrastructure such as schools, roads, and hospitals, thinking this could be an important input to the value of the property. Like if your property is located next to the best school in the city, then that might raise its value. So to implement the machine learning techniques, we selected randomly a set of roughly 1,600 properties and had these properties valued per manual appraisal. This method on the previous slide, hiring agents from the land survey department of the provincial government. So these are expert manual appraisers that did this process for 1,600 randomly selected properties. And we did this to create a truth about property value. For these 1,600 properties, we have a good estimate of what their true value is. The goal then is to try to figure out, are there alternative methods that we could use to predict property value through machine learning and computer vision, and then see how close we get to those estimates of manual appraisal. And the two techniques we use are first machine learning, which is using predictive models trained on available data to try to get as close as possible to a prediction of what that true value is, deploying different methods that might prevent us from making a mistake and trying to predict too closely or too accurately in one area that might not fit well in another area of the city. And so there's various methods that we deploy, and you can read about them in the working paper that is on the ICTD website. And I won't go into detail about those now, but in the Q&A I could. The punchline is that these are relatively simple and straightforward methods to apply, but they need data to support them. You need information about property characteristics that fit into the prediction algorithm. Likewise, computer vision relies on photos. So we had enumerators take pictures, photographs of these 1,600 properties, coupling them with information from the property census, and we try to use purely the photographs and some locational information to predict the quality of the property. And so the computer looks at characteristics of the photograph and tries to back out what is the quality of the materials, how large is the structure, and use only that information to predict value. And just to quickly give you a sense of what this information looks like, here's two photos of the property, one built from non-durable materials and one built from durable materials that are classified into these low and high value bands. And this is the information that would feed into the computer vision, for example, and the information that would be recorded in the property characteristics survey that would support the machine learning exercise. Finally, the government collected the location of important infrastructure, and this might be a little hard to read, but you can see this map of these locations throughout the city capture hospitals, health centers, public and private schools, police stations, etc. The government also mapped erosion throughout the city, which is a major risk to properties, that the property could be physically eroded through the collapse of ravines in the area, and that this really harms property value, as we'll see. Okay. Applying the machine learning technique revealed which features were most important. So this figure shows how many times a feature was selected by the machine learning models and the algorithm used that information to predict property value. And we could see that many of these characteristics relate to the individual property characteristics, like the property value, which is the second to last one here, and the distance from erosion, which is the most used characteristic at the bottom. But many also relate to the characteristics of the neighborhood or area, such as the average property value of surrounding houses, the distance to the city center, and just the location within the city, such as latitude and longitude. So I think this reveals that individual property characteristics matter, such as the materials used to construct the property, like wall quality here, but also area characteristics and relational characteristics, how far you are away from different amenities. To summarize these findings, which are again discussed in more detail in that working paper, we find that the machine learning algorithms can reasonably predict property values. The best performing model we use combined several machine learning techniques with an ensemble method and was able to accurately explain about 60% of the variation in property values in those accurate estimates from the land surveyors. The most useful data, as I said, was the location as well as building material data. And it seemed, I think, one thing that might come up in discussion is how complex do these models need to be and what capacity do tax authorities need to deploy them themselves? In this setting, we found that the most advanced models, like here, boosted trees is an example of a more complex machine learning algorithm, outperform the simpler ones. And I think this is a feature of the setting where there's a lot of variation. But you can imagine the more complex the model, the more difficult it might be for a tax authority to deploy itself. I think there's promising accuracy here that suggests that this can be a useful resource in low capacity settings. By contrast, the computer vision algorithms were less accurate, explaining only about 40% of the variation. But I think maybe coupled with machine learning could offer some promise for developing estimates of property value to support construction of property tax rolls to build that property tax base upon which to levy taxes, given the information that might be available. If you have only surface area satellite imagery or photos of properties, then this can get you part of the way to building a property tax register, absent making these enormous investments in manually appraising every household in a city, for example. I think these results highlight that there's potential for these methods, which is consistent with findings we see from other similar settings, like those in Kigali, Rwanda, as well as Senegal, which Victor will talk about next. Thank you.
Fantastic. Thanks so much, Gabriel, for this very fascinating study. This links very nicely with to the next presentation from Victor. So now we swiftly going to Senegal for some more empirical evidence on AI for tax. Victor, the floor is yours. Thank you.
Thanks a lot. Can you see my screen?
Yes, perfectly.
Okay, perfect. Thanks a lot, everyone, and thanks a lot for organizing this webinar. And I think, yes, it fits very well as a continuation of what you just discussed, Gabriel. So this project is a collaboration with the tax administration in Senegal, where we basically try to compare the method currently used by the tax administration to estimate property values to methods that rely more on algorithm. So the starting motivation, and it is really pretty much related to what was just discussed by Gabriel, is the fact that the success and fairness of the tax system depends on the accuracy of the tax register. And so building this tax register is a challenge when administrative capacity is low and when there is not a lot of information available on taxpayer. And so administration, typically, they want to do two things. They want to maximize coverage, so making sure every property, if you think about property tax, every property that should be registered is registered, but also the accuracy of the information in this tax register. And by accuracy of information, I mean, since the property tax is usually based on the value of a property, we want the tax register to have accurate information on the true value of property. And so to do that, and this is very in line with what Gabriel was talking about, two possible approaches are possible. One that we call discretionary approach, where the idea is to rely on bureaucrats to generate information. And the second one is more to rely on AI and algorithm, is what we call a rule-based approach, where basically the administration can build algorithm to leverage existing information, such as the one described by Gabriel, to generate this information. One thing that is important is that ex ante, both approaches might have pros and cons. So for example, if you think about bureaucrats might be able to have access to some local information on market values, for example, that is not or hardly accessible for the state. But on the other hand, bureaucrats might be corrupt, or they might lack the skill to properly estimate the value of property. And so what do we do with this project? We try to basically compare bureaucrats to algorithms. But first, what we want to answer is how does the discretion of bureaucrats affect the accuracy and equity of the property tax system in the context of Senegal? And second, we want to compare the existing system to more rule-based approach relying on algorithm. And we want to know to what extent this rule-based approach can be preferable. So we studied this in the context of Senegal, focusing on Dakar, the capital city, which is a context where the property tax system is underperforming. And so before, when we started this project, basically only 16% of properties in Dakar were registered in the tax register, and only 10% of the total potential or property tax potential was collected by the administration. So there is a lot of room for improvement. And so what do? Basically, we leverage the rollout of the first digital property tax census in Dakar that we use to introduce experimental variation. So we conducted a randomized experiment in which we try at scale different methodologies to estimate property values in different neighborhoods of Dakar. And this methodology gives more or less discretion to bureaucrats to value property, and so to assess the amount of tax that people should pay. So let me give you more details about the project we are studying. So basically, the first phase of this project was to work with the tax administration to develop a new digital tool which allows to manage the property tax system in the region of Dakar. And so this digital tool includes geocoded property data, so we can identify precisely where each property is located, and also include a property valuation algorithm that I'm going to describe very soon. And then there was a second phase that was conducted in the last 2 years by the tax administration, where it was to implement a comprehensive fiscal census, where the administration sent bureaucrats door to door to register properties and determine the value of these properties. And finally, there is the last phase that is happening right now as we speak, where people receive their tax bills and are currently paying. But what we are interested in today and what I'm going to talk about is really focusing on this first two phases, how the administration should use and combine bureaucrat with algorithm to determine the value of properties and how much tax people should pay. So what did we do? Basically, we implemented the randomized experiment. So here what you see is a map of Dakar where each small box or small square is a neighborhood with approximately 500 properties. And so these neighborhoods, they were randomly assigned to different methodologies during the fiscal census. And so each neighborhood had different methodologies to estimate the value of properties, and so the amount of tax people will pay. And so we're going to compare, using this randomized experiment, 3 different methodologies. The first one that we call discretionary, it's the method that is used currently by the tax administration. So with this method, basically, bureaucrats are going to the field, they see the property, they talk with the owner or tenants of the property in order to gather some information, but then they use their own judgment to estimate the value of the property. That's why we call it discretionary. We're going to compare this method to another method that we call rule-based, that is a bit similar to the point-based method described by Gabriel previously, where basically bureaucrats, instead of giving us the value of the property, they give us observable characteristics of the property, such as the material of the roof, whether there is a balcony, the number of floors, this type of things. And then we use an algorithm to predict the value of the property using these characteristics and satellite data on the location and built area of the property. And so to calibrate this algorithm, we use a method similar to what Gabriel described previously, where we hired real estate assessors who gave us like market values for a sample of properties. And we use that values to calibrate the algorithm. And finally, we're going to compare these two methods to a third one, where basically we use a pure rule without any bureaucrat input. So the idea here is we only use satellite data to predict the value of property. And so how do we compare these two different methods? To compare these three different methods, we're going to use a benchmark that's going to be provided by licensed real estate assessors that we hired to give us the true, or what we consider as the true market value for 5,000 properties in Dakar. And so for these 5,000 properties in Dakar, we know the true market value provided by these assessors, and we know the market value estimated with the different methodology by the tax administration. And so we can compare these different methods in terms of accuracy and equity. So what do we find? We find three main results that I'm going to very quickly present, and then if you are more interested, I'll give you a link to the paper, the working paper in the chat later. And so the first result is that we show that in the current bureaucrat discretionary system, where bureaucrats use their own discretion to value properties, we find that it generates strong undervaluation and tax inequity. Basically, bureaucrats, they strongly underestimate the value of properties, and they do that in a way that is inequitable. What does inequitable mean? It means that it generates a lot of dispersion. So similar properties are likely to pay different amounts, what is called horizontal inequity, and it generates regressivity. So basically, bureaucrats, they undervalue even more expensive properties, which means that rich taxpayers pay less than poor taxpayers, which is called vertical inequity. Our second key result is that both types of algorithm that I discussed previously, so the pure rule and the rule-based process, improve accuracy and equity significantly compared to the bureaucrat. So we show that they reduce dispersion and they improve the progressivity of the tax instrument. We also show that the pure rule system slightly outperforms the rule-based process. So basically, in this context, bureaucrats, when they collect observable characteristics, they do mistakes which harm tax equity. But we do find that there is a trade-off for low-value properties where bureaucrats have some advantages. Basically, we show that for low-value properties, the algorithm methods are more likely to overestimate the tax compared to what people should pay. And so if the tax administration care of making sure poor people are not paying more than what they should do, then maybe for low-value properties, they want to use bureaucrats. We are able to disentangle the mechanism that explain this result, and we show that basically bureaucrats lack knowledge about market values, especially at the top of the distribution, so for expensive properties. And we show that they are biased towards some specific taxpayers, in particular retired taxpayers. But we can rule out corruption as the main driver of the result, so it's not because they are corrupt. And finally, we show that bureaucrats, that it will be very hard for the tax administration to select, to do more screening, so select more bureaucrats or to train them more. And that even with more training and more screening, basically the algorithm methods are more effective in terms of accuracy and equity. And so to conclude, what do we get in terms of optimal policy in this context? And so the optimal policy in this context, we think it's kind of a combination where the administration will use the pure rule everywhere, but will have bureaucrats to check for low-value properties to make sure poor people are not paying too much. Thanks a lot, and I'm going to stop here.
Fantastic. Thanks, Victor. This is great work. I particularly like the implications for equity and this interesting sort of recommendation of combining different solutions. Great. I think at this point we'll go with Joe, which will probably abstract a bit more from these empirical findings and tell us more about what all this mean for trust. Joe, the floor is yours. Thank you. And please feel free to add questions in the Q&A. Don't hesitate. All right. Yes, I think your screen, your slides are coming up. Yes, we can see them.
Okay, brilliant. I'm in a room and on display settings, I have the screens the wrong way around, which is why it took me a few moments to unmute there. So, which is yeah, very predictable for a presentation on technology there. But yeah, thanks everybody. Really interesting presentations, Victor and Gabriel. I've taken down a lot of notes, and I hope everybody else has too, because that was really interesting stuff. So my name's Joe. I'm an economic policy specialist here at the World Bank, specializing in tax and domestic revenue mobilization, both on the admin and the policy side, with a particular interest in technology. So I'm just going to start today by talking about a key threshold that we're always banging the drum about here at the World Bank, which is a 15% tax to GDP threshold. It's a real focus for the World Bank because we view that threshold as a key for low-income countries moving from a low-income status to a middle-income status. Achieving a 15% tax to GDP threshold is critical for sustainable development for multiple reasons, but the main one which has been mentioned on this call was paying for critical government services. And now digitalization and digital transformation of tax administration can have a significant impact on that tax to GDP threshold. I've got some interesting figures and points here on screen, but there is research that shows that tax digitalization can actually have a 2-3% impact on tax to GDP for a low-income country. That means if you are a country that has a tax to GDP threshold between 12 and 15%, tax digitalization could be the key that unlocks your sustainable growth. That could be the key that moves you from a low-income country to a middle-income country. And it's around about 20 to 25 countries that sit between that 12 to 15% tax to GDP threshold. So that's about 1 in 8 countries in the world where tax digitalization could be the key that unlocks development. So yes, what am I talking about today? I'm talking about AI, tax digitalization, and trust. So we've done some research here at the World Bank which explores this concept of trust and how it interacts with domestic revenue mobilization and digitalization, and for important reasons. One, trust is crucial for domestic revenue mobilization. In terms of reducing enforcement costs, encouraging voluntary compliance, trust in government and the administration is critical to achieve those objectives. Trust is also the foundation of the social contract. We've seen a number of scandals around the world, or a number of protests, or even in some scenarios, governments falling as a result of tax policy or tax administration decisions that populations don't like. And what is tax role in this? It's a key access point. It's a key touch point between citizens and government. And the erosion of trust can lead to a vicious cycle. Erosion of trust can lead to lower voluntary compliance, which leads to fewer government services, which again can have a vicious downward spiral. And also, the opposite is true. And tax digitalization is a significant disruptor of this access point. So we acknowledge that tax is a key access point. This is critical for DRM and the social contract, and digitalization represents a significant disruptor of that access point. I'm going to cover this slide very quickly. It just covers a South African case study in SARS, the South African revenue, are really good at collecting data on tax. So if you want to learn more about this, please reach out to me afterwards. But yeah, they've do some really interesting surveys, which produces some really valuable results. So how do we define trust and tax morale, and how do we think this feeds into voluntary compliance? So we've done some research on this, everything from literature reviews and reviewing surveys, looking at fairness analysis, but also this is grounded in case studies. Leveraged the World Bank network and collected a high volume of case studies. And what we've done is we've constructed almost this framework that we think explains how tax morale and taxpayer trust feeds into voluntary compliance. And I'm going to focus on 6 of these drivers at the bottom here that I think are relevant for tax and digitalization. So the first driver of taxpayer trust is transparency. So making, in the context of tax digitalization, making sure that taxpayers understand the law, understand the decisions have, how decisions have been made. The second one, representation. This is taxpayers having the opportunity to challenge certain decisions. The due process, this is taxpayers being notified of particular government action that might not benefit them, and being entitled to having certain procedural protections when seeking to challenge that. Administrative capacity and effectiveness. When tax administrations work well, that builds trust. Having that trust in the administration's capacity and effectiveness in levying taxes supports taxpayer trust and voluntary compliance. Stability and predictability. Even if it's a decision that a taxpayer doesn't like, if it's a decision that they predicted, that can build trust. And then this last one, enforcement legitimacy, viewing enforcement practices as fair and proportionate. Now, in our research, we looked at lots of different types of technology, which I've put up here on screen. Everything from e-invoicing, web scraping, web crawlers, chatbots, but also artificial intelligence and data analytics. We did an evaluation of all of these different types of technologies and looked into how we thought, assuming that this technology was implemented effectively, how do we think this type of technological advancement impacts on the drivers of trust? And I'm going to turn your attention to the top line here. And overall, it's a very positive story. There's a really important role for technology, and it can play a really important role in enhancing trust. And even when there are negatives here, or we view technologies that potentially risk having a negative impact on a particular driver, we've identified a number of mitigations that can be put in place to make sure that you maximize the benefits without maybe falling into the trap of negatively impacting some of the other drivers. I'm just going to focus in on data analytics and AI, and we're going to start here with transparency. And providing that algorithms are transparent, this shouldn't be an issue at all. So I'm going to try and focus here on scenarios where perhaps we're looking at more kind of black box style algorithms where there isn't the level of clarity that maybe taxpayers would need in order for this not to have a potentially negative impact on trust. And there's a few cases here. And some of these cases aren't necessarily related to AI and machine learning. This is broader than this. This is more about kind of the use of algorithms, automation, and data analytics. But there's an example here which is far and away, I think, the most famous kind of algorithm example, and the potential negative impact that this can have on trust, which is the use of automation in this scenario, and also using averaging that results in inaccurate debt calculations, and due to the lack of human oversight, it resulted in the government actually paying out 1.2 billion Australian dollars to taxpayers, because as a result of these automatic debt calculations and automatic processes in order to recover those inaccurate calculations. So here, having transparency over the use of particular algorithms in calculating a tax liability, providing that there's transparency in that scenario, this shouldn't have a negative impact on trust. The second one, representation, I don't have a case here up on screen, but this is linked to transparency. If you have clear oversight, if you have clear transparency of a particular algorithm or how a certain tax decision has been calculated, then that's easier to challenge. So making sure that those are combined, and also with due process as well. If we understand how an algorithm operates, if we are transparent in terms of how that is implemented, we allow taxpayers, or give taxpayers the opportunity to challenge certain decisions, and we have notified taxpayers where a particular decision might negatively impact on them, then data analytics and AI shouldn't have a negative impact on trust through those three drivers. It is a risk, and we flagged it here as a risk. So I think this is really important for tax policymakers and tax administrators when utilizing this sort of technology, that it is as transparent as possible, there's the opportunity to challenge, and there's due process around that. Another case we've got here on screen is, tax refund freeze, a case in North America where tax refunds were frozen because of the triggering of certain automatic tests, but actually 80% of those refunds were refunded. And there was a significant time lag here between those refunds being frozen and those decisions being corrected. In that scenario, taxpayers weren't even notified or told why their refund was being frozen. So again, having a clear understanding from start to finish of how algorithms and machine learning and AI works, how it impacts on particular tax decisions, and making sure any negative, any decisions which negatively impact a taxpayer, they are notified and given the opportunity to challenge. And now these last three is a largely positive story. AI has there's a real opportunity for AI to improve and increase administrative capacity and effectiveness. The cases that we've already talked about here on this call, there's a real opportunity here for AI to increase administrative capacity. And then this fifth one, and I think the most important one, and is one that's been touched on a lot on this call, is stability and predictability. In the cases that have been mentioned around property tax on this call, we've also found other evidence and lots of other research which shows the positive role that AI and data analytics can have in just providing a stable and predictable way of calculating certain tax decisions. And I think you mentioned that actually the discretion of bureaucrats can lead to an undervaluation in property valuations. We've also seen that in research, that actually having humans solely making decisions without the support of technology and algorithms can lead to more unpredictable outcomes. So here we see this as a real potentially positive driver. And then this last one here on enforcement legitimacy, this isn't really a positive or a negative. It can both improve enforcement legitimacy in terms of reducing those opportunities for that human-to-human interaction, which can lead to corruption. But also at the same time, we've seen this case here in Denmark where taxpayers actually owed less than the smallest unit of currency. I think it was like 0.5 Danish ore, and were receiving penalties and interest as a result of that. Again, an example of the use of algorithms in a way that may reduce enforcement legitimacy. But if there's already a lack of trust in a particular administration, actually the use of machine learning and AI can have a positive impact. So what are the cross-cutting lessons that we've seen across all types of technology, not just AI and machine learning? What lessons can tax administrations take away? What lessons can tax administrations take away to make sure that these different types of technology are implemented in a way that boosts trust and mitigates any potential negative impact? Transparency is a cross-cutting lesson across all of these types of technology. Engaging with stakeholders, so ensuring that there are sufficient time lags in terms of the implementation of this technology. Training and guidance, making sure that tax administrators understand the algorithms that they're using, understand the technology that they're using, and again, coupled with time lags to make sure that both taxpayers and officials understand. Regularly monitoring, evaluating, and adapting machine learning tools is critical. Just because you've implemented a certain AI solution, say again in property tax, and it might not work as effectively as you'd like it to first time, that doesn't mean that it can't. So making sure that you're monitoring and evaluating the outputs, running various checks for certain bias that you can run for machine learning and then AI tools, and making sure that we're adapting those as the evidence comes through. And active human intervention. So this isn't just human in the loop, this is active human intervention in order to mitigate issues. So this can be in terms of reviewing certain decisions, but also giving taxpayers the opportunity to speak to a human if they are challenging a decision. These are the 5 cross-cutting lessons that we have identified, and all 5 apply, I think, to machine learning and AI. But to conclude, I think this is a really positive story. The potential of AI and machine learning could have a significant impact on tax to GDP and a significant positive impact on taxpayer trust, which can enable those 1 in 8 countries to move from being a low-income country to a middle-income country and to help achieve sustainable growth. There are some lessons and there are some mitigations that need to be implemented to make sure that the social contract and taxpayer trust is protected. But providing that that's done right, this is a really positive story, evidenced by the research that Victor and Gabriel have demonstrated today.
Awesome. Thanks so much, Joe. Extremely interesting lessons here. Thanks so much for sharing. I also particularly liked how all those big scandals come from high-income countries, and so meaning that probably this discussion matters for them as well. I believe we have 10 minutes left for Q&A, and I think we could address a question which I think fits well in this discussion, which is about, and I would like first Gabe and then probably Victor to spend a couple of minutes on this, which is about the preconditions that tax administrations need to have in place to then unlock AI adoption. So it's about sequencing and priorities. I wonder, from your perspective, from your exposure to local tax administrations in DRC and Senegal, what do you think are the key factors, the key preconditions, the basics that needs to be there to then move to AI?
Yeah, that's a great question. I think the first one is data, that you need some form of information. I think all of the presentations stress that. Tax authorities everywhere have some form of information. And I think, at least in the setting of Kananga, we're able to show that even that limited information, or from supplemental sources like satellite imagery, which is easily available, if though sometimes expensive, can provide a stepping stone towards aggregating or collecting more information, and that there can be whatever information you have, there might be value to deploying these methods, that their accuracy improves as you get more information and their value improves. And the other is skills. I think Victor could maybe speak more to this question, but the ability to deploy these methods presumes that there's someone who can do it in the tax authority, or being open to collaborating with other researchers, and maybe potentially today relying on tools like ChatGPT to take on some of that work, but it's hard to know how reliable that reliance could be.
Thanks. No, that's a great point. I think to add to what Gabriel just said in terms of the data, I think what was instrumental in the case of Senegal is to have like a unified geocoded cadastre. So basically to have data where just being able to locate precisely taxpayers, that was the first step. And that's something that was not really available previously. And so that was instrumental in allowing us to deploy this new algorithmic methods. Then I think working on the method themselves, I think can be also very challenging. First, there are like legal aspects that are important to consider, I think, to make sure that the methods are fit within what is legally described within the tax codes and things like that. So that's something that is also very important. And also in terms of being able to explain to the administration how this type of methodology is working. And I think there is a trade-off between using very complex methods and using methods that are more transparent. And I think this is related to a question in the chat I've seen in the chat, I think, where in our case in Senegal, for example, we decided in the end to use more simple methods, more like linear methods, instead of using more complex model, just because we wanted the methods we wanted to be able to explain the methods to everyone in the tax administration. And so for people to understand exactly how the method is done. And in terms of the skills and how to develop these methods, when we did it in partnership with the administration in Senegal, we talked a lot. There are many countries where they are using this type of methodology. And so we talked with people at ICTD who are like experts in implementing point-based methodology, who help us select the characteristics that we will consider, but also with people, for example, working in the tax administration in South Africa, where they have extensive experience on that. So there are many people working on these methods. So I think so many people have think about this question about how do you develop them, and so resources are available in that sense.
Thanks, Victor. I see many questions in the chat which are being answered live. I wanted to pick one for Joe, also to conclude this session. There was an interesting question around how should governments find the right balance between making the algorithms transparent to increase trust against the risk of taxpayers gaining the system to reduce their liabilities. This has been answered already by Gabe, but if you have other insights to this or around this, please feel free.
Yeah, sure. I guess it depends on what we mean by gaming the system. If taxpayers should be entitled to having clear legislation and being able to predict what their tax liability is going to be in different scenarios, and that's not only important for trust, but that's also important for various other things like investment. And ensuring that there's kind of due process. So I guess yes, there is a risk of gaming the system, potentially through evasion and avoidance. But I think that's why implementing these tools in select scenarios and also ensuring that you implement other type of tax policy measures. So, for example, looking at some of the OECD BEPS and 4 actions, looking at exchange of information, trying to ensure that you have neutrality across your tax system. In my mind, they're more effective ways of reducing evasion and avoidance, and actually having a transparent and clear algorithm in terms of how you would, certainly in terms of tax calculation, that's more important. If it is in terms of identifying potentially non compliant taxpayers, then I think it's a different story. And then I think you're going to be looking to balance more towards administrative effectiveness and ensuring that you give taxpayers the opportunity to challenge any incorrect decisions and using that to outweigh the loss in transparency. So you're going to have to say, we've identified you and we think that you have fallen foul of these rules, and making sure that they have the opportunity to challenge. So yes, it is a balance, but I think it depends on how and where you use those algorithms.
Thank you, Joe. I think you were also replying via text to another question. So if it's a quick answer, you can also feel free to share it now. The question was about AI helping to identify potential taxpayers who are not registered yet. This could be the last question.
Yeah, it can, but I think what's a really important message is AI isn't going to solve every solution, every tax problem. There's a wealth of different types of technology and approaches. Again, information sharing is really critical for large taxpayers. And there are other types of technology like web scraping and web crawlers and things like that, and even using kind of geospatial technology as well in terms of identifying potential properties. So there's lots of AI and non-AI solutions to that. So I wouldn't just solely focus on AI there. I would include it as part of a broader analysis.
Fantastic. Yes, I see other questions in the chat, but I fear that we don't have time for just them. I believe, yes, we reached the hour. The time's up. I think then it's just time for me to thank you all for joining us for this rich and thought-provoking discussion. We heard today that artificial intelligence holds real promise for improving tax administration in low and middle-income countries, especially with property tax. But again, I think the main message here is that the AI is no silver bullet. As you all have reminded us, the success of AI and machine learning depends not only on the technology itself, but on preconditions, governance, capacity, skill set, trust, the human factor. I think it was a very interesting point, having a person in the room that knows how the algorithm works. Interinstitutional data sharing is another key important preconditions. It's a very complex picture. So that a special thank you to our speakers today for sharing your insights and experiences. Thanks to the very engaging audience. Thanks for your questions. Feel free to reach out to us later on. This conversation does not end here. We actually hope that this webinar would spark further reflection, research, and collaboration. And by the way, we're already working on the next section of this webinar series. So please watch this space. So that I wish you a good reminder of the day. Thank you and goodbye.